Hello, today we are going to study dissolution. In dissolution, the very first step is you have to prepare realization account. So basically the firm has decided to close the business and sell off all its assets and settle off all its liabilities. So the very first step in dissolution chapter is that we prepare realization account. We will understand this account by breaking up into various steps. So the very first step is you transfer all the assets from the balance sheet that is given in the question. So you transfer them one by one. Okay. So you transfer all the assets except for cash and bank, deferred revenue expenditure, profit and loss, loan account of the partner and current account of the partner. Except for these, you transfer all the assets one by one on the debit side of realization account. Similarly, from the old balance sheet, you transfer all the liabilities one by one on the credit side of realization account. So when you are transferring the liabilities, you transfer all the liabilities except for general reserve, P&L, capital account of the partner, loan account of the partner, current account of the partner and bank overdraft. Apart from this, you transfer all the liabilities one by one on the credit side of realization account. With regard to debtors and provision for doubtful debts, debtors gross amount you transfer here and provision you transfer separately on the credit side. With regard to IFF and WCF, you transfer the whole amount of IFF if you have recorded investments on the debit side. And for WCF, you compare the value of WCF with workers' liability. Whichever amount is small, that amount comes on the realization credit side. So basically, there could be four situations. If fund is 2500 but liability mentioned in the adjustment is 1000, you compare the two. The lower amount is 1000, so in realization on the credit side you will write 1000. Later on in the question, we have to distribute the remaining fund. So in this case, since I have transferred the entire 1000 in realization, we will be left with 1500 later on to be distributed among partners. We take another case. Say suppose the fund is 2500 and no liability is mentioned in the adjustment for workers. Then in that case, when I compare the two, the smaller amount is 0. So in realization on the credit side, workers' compensation fund will be 0. So since I have not transferred anything to realization, I will be left with 2500 in the fund to be distributed among partners later on. Similarly, if fund is 0, liability is 1000. So if I compare the two, the small amount is 0. Again, you will not transfer anything to realization account. And in this case, you also do not have any money in the fund to distribute. In this particular case, the fund is 5000, liability is 7000. So when I compare the two, 5000 is the smaller amount. So in realization credit side, I will write 5000, right? And I'm not left with any amount to distribute because I have transferred this entire 5000 to realization. So this is step 1, 2, 3 and 4. So basically in step 1, I repeat, transfer all the assets one by one except these. Step number 2, transfer all the liabilities one by one except the ones that I have highlighted, mentioned here. Remember to transfer IFF and WCF. Debtors full amount you show here, provision you show here. Then we read the question and see what assets have been realized. That's the next step. So whatever assets have been realized, that means money is coming in the business. So you will write bank or cash depending upon what is there in the old balance sheet. So if in the old balance sheet you have cash at bank, then please use bank everywhere. If in the old balance sheet cash is given, then please use cash. If both are mentioned, then please stick to bank. So I will write money is coming in, so bank has to be debit and realization credit. And I'll write the name of the asset sold and whatever amount I have realized by selling that asset. Sometimes the asset is taken over by the partner, so I will write partner's capital account always, not the current account. It's always capital account. Again, write the name of the asset in bracket and whatever amount he is supposed he has agreed to pay for an asset, we will record it here. Now for some assets, there is nothing mentioned in the adjustments. And if those assets are tangible assets, tangible means something which you can touch and see, like building, premises, furniture, machinery, as well as for investments and as well as for the debtors which you have mentioned on the debit side of realization. If nothing has been mentioned for them in the adjustments, you have to realize it in the book value. So if suppose stock is there of 80,000, nothing is mentioned in the adjustment, you still have to sell it for how much? 80,000. This is only and only for tangible assets, investments and debtors, and not for any other assets. So it does not apply for prepaid expenses, accrued income, okay, goodwill. So this rule does not apply for those. Similarly, in the adjustments, they could have mentioned some assets which is not there in the old balance sheet, okay, or there could be some bad debts recovered. So all this also results in money coming into the business. So cash or bank will be debit and record the amount on this side. Further in the adjustments, they will also mention the liabilities are paid off. So whenever we are paying off the liabilities, it needs to come on the debit side of realization account. And how do you show it? Any liability you are settling it, you need to write to bank or to cash, write in bracket the name of the liability for which you are paying. So for example, you are paying creditors. So to bank or to cash, bracket creditors, and whatever amount you have paid them. And then these are 4 compulsory payments. So if it is there in the question, you need to pay them. So whatever liability for workers is mentioned in the adjustment, please settle it. Whatever employee provident fund is mentioned in the question in the balance sheet, please compulsory pay it because it's employees' money. If there is any unrecorded liability mentioned in the adjustment, you need to pay it. Similarly, if any contingent liability is mentioned in the adjustments, you need to pay it. Example of contingent liability could be bill discounted and dishonored. Sometimes a liability may be taken over by a partner. So in that case, I will write partner's capital account to partner's capital account and whatever value he has agreed to take it for. There could be realization expenses, also known as dissolution expenses. If these realization expenses are borne by firm and paid by firm, then you write to bank. But if these realization expenses are borne by firm and paid by partner, you write to partner's capital account. Now the partner may also be appointed to carry out the dissolution work for which he is getting remuneration, also known as commission. In the transactions, they will say amount credited to the partner's capital account. So for all this, you will debit realization and credit partner's capital account. Further, partner's loan account may appear on the liability side. If partner's loan account is appearing on the liability side, suppose his loan is 10,000, but we are paying him 10,500. So the extra amount that you pay him goes as interest and comes as to partner's loan account, bracket interest and 500. But say suppose the loan amount is 10,000 and you are paying him only 9,800. So 200 is the claim given up which you need to record it on the credit side of realization account. Further, before you find out the profit or loss on realization, you need to do one more step. You need to check that all your liabilities which you mentioned in step number 2 and step number 4 above, that is, you have settled them. So when you check, so basically you have written many liabilities in step number 2 and step number 4 here. So you need to make sure that whatever you have written here has been settled or has been paid. Okay, so when you double check, you have to ignore WCR, IFF, provisions if any, and any liability which you have settled either by giving an asset or by cash, whether paid more or whether paid less does not matter. But if a liability is settled, the word settled should be there. If it is settled, then you ignore those and the remaining liabilities you need to settle compulsory before you find profit or loss. which you distributed among the old partners in the profit sharing ratio.